Now, in week 5, we're going to talk about accounting theory. And our learning objectives in this video is to 1. Identify and discuss the underlying assumptions or concepts of accounting. And we've already talked a bit about this, the business entity concept, and so on. Number 2, identify and discuss the major principles of accounting. And number 3, understand what accounting conventions are. We begin with the assumptions that the accountant takes or assumes when he is recording business transactions or presenting the results of business transactions. And the first one is the business entity concept. Now, we were introduced to this in the very first video. But again, the business entity concept assumes that each business has an existence separate from its owners and other businesses. And the importance of this is it defines the scope of the business, such as a physical fitness center, a grocery store, so on, and identifies which transactions should be recorded on the company's books. Another assumption is the going concern assumption. And this states that an entity will continue to operate indefinitely unless there's strong evidence that the entity will be terminated. And the importance of this one to the accountant is it allows a company to continue carrying plant assets at their historical costs, in spite of the fact that the market value of those assets may have increased. But they would only have a value if they're going to be sold. We do not assume they're going to be sold. That the business is going to continue operating with those assets. Third one is a monetary measurement, is the use of the monetary unit, such as a dollar, instead of any other physical or units of measurement. Now, this is important because it provides accountants with a common unit of measure to report economic activity. This concept permits us to add or subtract items on the financial statement. And that goes in hand with the stable dollar assumption. That states that the dollar is the accepted and reasonable stable unit of measurement. And it permits the accountant then not to have to make adjustments in the financial statement because of the changing value of the dollar or because of inflation. So we assume that the dollars on the financial statements, regardless of when they were spent, is a stable unit. And lastly, the periodicity. Now, we saw this assumption when we were doing adjusting entries. The need for adjusting entries came about because we had divided the entity's life into economic periods. And this permits us to prepare financial statements that cover periods shorter than the entire life of the business. Thus, we know how well a business is performing before it terminates its operations. The need for adjusting entries arises because of this concept. So those are some of the underlying assumptions. We will next look at the major principles in accounting. Now we're going to look at major accounting principles such as the cost principle, revenue recognition principle, the matching principle, gain or loss principle, and the full disclosure principle. Now these principles are what are known as GAAP, generally accepted accounting principles. And they set forth the standards for presenting financial information. A standardized presentation format enables people who use these financial statements to compare financial information across different companies. Now, generally accepted accounting principles have either been developed through accounting practice or established by authoritative bodies, organizations such as the American Institute of Certified Public Accountants, the Financial Accounting Standards Board, the Securities and Exchange Commission, the Institute of Management Accountants of America. Now, the following principles, the cost principle, dictates that purchased or self-constructed assets are recorded at their historical costs. Historical cost is the amount paid to acquire an asset and place it in a condition for use. This principle sets forth, number one, what goes into the accounting system, i.e. transaction data. Two, when it is recorded, at the time of exchange, for example. And three, the amounts, the exchange prices at which assets, liabilities, shareholders' equity, revenue, and expenses are recorded. This may also be in literature known as the historical cost principle. To the revenue recognition principle, the accountant does not record revenue until the seller acquires the right to receive payment from the buyer. The seller requires this right from the buyer at the time of the sale of the merchandise or at the time service has been provided. Legally, a sale of merchandise occurs when the title for the goods passes to the buyer. Now, this principle informs accountants that revenues generally should be recognized when services are performed or goods are sold. The matching principle states that expenses should be recognized, that is, recorded in the records as they are incurred to produce revenue. Why is this important? Because it indicates that expenses are to be recorded as soon as they are incurred, rather than some future date when they are paid. Now there's the gain and loss recognition principle, and that states that gains may be recorded only when they're realized, but losses should be recorded when they first become evident. That tells the accountant to be conservative when recognizing gains and losses. Gains can only be recognized when they have been realized, i.e., I've sold the asset, therefore I have the gain. Losses should be recognized as soon as they become evident. Thus, potential losses can be recorded, but only gains that have actually been realized can be recorded. And lastly, the full disclosure principle states that information important enough to influence the decisions of informed user of financial statements should be disclosed. This is important because it requires the accountant to disclose everything that is important. A good rule to follow is, if in doubt, disclose. Another good rule the accountant follows is, if you're not consistent, disclose all the facts and the effect on income. And that concludes the major principles. We then look at some accounting conventions. Now we look at three accounting conventions: the cost-benefit, the materiality, and conservatism. To begin with, the cost-benefit convention states that operational information should be included in financial statements only if the benefits provided exceeds its cost of providing it. And this is important because it lets the accountant know that the information that is not required should be made available only if its benefits exceed its costs. An example may be that companies going to the expense of providing information on the effects of inflation when the inflation rate is very low. Okay. Number two, materiality is a convention that allows accountants to deal with immaterial or unimportant items in an expedient way. Only items that would affect a knowledgeable user's decision are material or important. And this allows the accountant to treat immaterial or relatively small dollar amount information in a theoretically incorrect but expedient manner. For instance, a wastebasket can be expensed through capitalization rather than set it up and depreciate it for 30 years. And next, the conservative convention states that transactions should be recorded so that assets and net income are not overstated. And this convention warns accountants that assets and net income are not to be overstated. Anticipate and record all possible losses, but do not anticipate or record any possible gains, is a common advice under this constraint. Also, conservatism application of the matching principle involves making sure that adjustments for expenses for such items as uncollectible accounts, warranties, depreciations are adequate. So these are some of the conventions and major principles and assumptions that underlie what the accountant records, when they record it, and how the data is presented on financial statements. And this concludes our little chapter on accounting theory.